All right, so let's begin this awesome show quickly. And thank you so much, Safir sir, for joining us tonight. It's an honor to be hosting you. And so let's, without any further ado, let's quickly begin. आज का हमारा टॉपिक इज मार्केट की बात विद साफिर सर. बहुत सारी सर आपसे अच्छी अच्छी बातें करनी है, बहुत कुछ सीखने का मन है मेरे को आपसे. तो throughout this show I would try to learn as much as I can from you. थोड़ा सा हम लोग मार्केट में अभी करंटली क्या चल रहा है उस पर भी डिस्कस कर सकते हैं. थोड़ा सा आपकी जर्नी के बारे में मैं जानना चाहूँगा. थोड़ा सा आपके जो इन्वेस्टमेंट फिलोसफी या ट्रेडिंग स्ट्रैटेजीज हैं उसके बारे में जानना चाहूँगा. थोड़ा हमारी ऑडियंस है, आई माई सेल्फ एम वेरी न्यू टू मार्केट्स. आई तो कुछ अगर हमारे जो जो मेरे साथ जो नए लोग, एक स्टॉक मार्केट में एक बाढ़ आई है, एक नई पूरी एक जनरेशन जुड़ रही है, उनके लिए कुछ एडवाइस हम लोग आपसे देना चाहेंगे. एंड इन जनरल बहुत कुछ आपसे सीखना चाहते हैं. तो हाउ अबाउट वी जस्ट बिगिन विद योर जर्नी. हाउ डिड यू get into stock markets and how has your journey been so far? अगर हम कुछ उसके बारे में डिस्कस कर सके सर.
Yeah, hi, good evening to everybody. See, my journey into the stock market happened more out of the fact that there was so much of buzz around me when I was still a student and did not have any adequate amount of capital. I came to the market with the least amount of money that somebody can expect. I think it was 4,700 or 4,800 rupees, and that was my initial capital. And I actually, would hear so many people talk about the fact that they had bought stocks and they had gone up, and people would go to apply for IPOs and they would buy forms, at time physical forms, and fill it up, etc. That it intrigued me because I was studying in a commerce college, the Shriram College of Commerce, and people around me knew a lot about the markets and I did not. So I went to a leading chartered accountant and asked him who to invest that money for me, which he did. And I was very curious. I thought the next day itself I would have made some money, but that's not how life is. And I used to be very excited that point of time because the rates would come in the newspaper. So I would look up the newspaper rates literally, continuously to see whether the stocks had gone up. The person had bought 100 shares. Only 100 shares is all I could buy that time, of a company called Nagarjuna Fertilizers at 48 rupees. And much to my disappointment, after I had waited for a significant period of time, I thought I would have made a lot of money. So I went back to that person saying that, please tell me, how much of money is this worth? And I got the shock to know that it was only worth 13 rupees. So from 4,800 rupees of very limited capital that I had as a student, while still studying, my capital was eroded to 1,300 rupees. And I couldn't believe it. And I told that person that, how can it be? You're such a leading chartered accountant. You know how to read balance sheets. You know way more than a normal person would know. How is it that this stock hasn't worked? And I was told that this is what happens. It is not necessary that what you buy always works. There can be many other factors. I did not believe it. I just felt that this was something wrong. So I said, but it can't happen. You are an expert. I can understand it happens to me as an amateur. So the reply I got was that if you think it is easy, why don't you figure it out? And because I've generally been very determined in my life, with whatever I did, I decided to figure it out, and that started my journey. And in the initial days of my investing, because of capital restraint, now just imagine 4,800 rupees has been reduced to 1,300 rupees. In the initial days, I would see, I would start reading about some companies, and I knew that companies like Bajaj Auto and Colgate and Unilever, etc., were very great companies at point of time, but I could not afford to buy them. So I used to travel to different parts of the city after looking at advertisements in the newspaper to try and find if somebody was willing to sell one share or two shares, which is what I could afford at that point of time. And then I started creating my portfolio with that. That at that point of time, there were, the exchange did not allow trading in one unit, so you had to buy a minimum market lot, and that started my journey.
Right, that's absolutely fascinating, sir. So from then on, sir, so like till, so which year was this? I'm sorry, I missed that when you started it.
Actually, the year is irrelevant because for two reasons. First,
Hmm.
I was still a student, so that didn't really
Hmm.
help
Hmm.
because what I'm trying to say is that there are two learnings from this. One learning
Hmm.
is that
Hmm.
you can start with a small amount, which is very relevant for me. And
Hmm.
the
Hmm.
the second part of it is that I didn't have any clue. So it's not
Hmm.
as if
Hmm.
after buying those shares I was really doing anything in the market. Then between
Hmm.
that time and the time I finished my studies at Sri Ram College and I completed my law, in between I would have not done much because I
Hmm.
didn't have
Hmm.
capital. So
Yeah.
that technically, it's like using your pocket money and buying
Hmm.
some shares just because you felt that you should do it, and then over a period of time realizing that you have
Hmm.
let certain years of your study time, certain years of that time pass by, and you've really
Hmm.
not done much. Except that I had started reading at that point of time. I would read a little bit of the newspapers or read a little bit annual reports. I was still not very clear about, because the management commentaries never used to be like they are today. There were never
Hmm.
any analyst meetings. The companies were not as transparent. Even the stock prices were not very transparent, in the sense that you bought it fine, but you never knew whether you got a day high or a day low, etc.
Hmm. Hmm.
And therefore there was a gap between that time and the time when I really started investing, which had happened way later,
Okay.
when I believed that I could understand a little bit more. And of course, it was a rough start,
Hmm.
but there were so many learnings in that, which even today there are so many learnings, and those learnings actually were my biggest teachers.
Hmm.
Many of those learnings were mistakes. Many of them were omissions. So I made mistakes buying stocks. I made mistakes missing stocks. I got carried away when I went. You would go to a friend's house for dinner, and he will tell you that he bought XYZ shares and they've gone up so much, and you felt that he was the best expert and you would come and buy those. But that's not how the stock market works. And I
Hmm.
kept paying my fee till the time I sort of became independent. And that's
Hmm.
one of the reasons why, I'm a little bit headstrong when it comes to, even if you see on Twitter, the reason why I try to be a little headstrong is because you need your own determination. Time is your friend. The
Hmm.
stocks are your friend. Corporate growth is your friend, but you need your own determination, and you need your own temperament vis-a-vis the money that you have. Because one man may have surplus, one man may be cutting down his expenses, one man may have an emergency the next morning, and he has to pull out and has to sell at a wrong price. So you have to balance all these things. Risk is very different for people. Some people have the appetite to see drawdown. Some people cannot see it, not because they can't see it only by temperament. It can impact their way of life. So you have to create a balance between all this, and then when you become a little more hardened, which you will become by investing, so investing is going to do two good things for you. One, it will help you understand and build a portfolio, and on the second side, it will be a very good teacher that will teach you a lot about life and temperament and patience and risk and behavioral science and many other aspects. And when you've sort of balanced this, then you are more ripe to sort of do better as an investor than you traditionally were.
Right. So in this journey, like when you finally started getting really into the markets, did you learn just from the markets by making mistakes and then doing it the better way again, or did you go for some books or some, there are so many things available today. So right from Twitter channels to there are courses available on stock market. So where did you learn about stock markets?
So I did no course on the stock market, because most
Hmm.
of the courses that were existing were on technicals, which was not my way of investing.
Hmm.
At the same time, even if I was reading books, for example, I may have started reading with Peter Lynch and then read a little bit of Buffett. And that time, Buffett was not so much into his letters. The letters had not come in. So you were just reading about him rather than reading what he was saying. And you started understanding a little bit more. But the practical difficulty was that capital was still limited, because your journey had just started. I was a newbie, and when your capital is restricted and somebody tells you that, as an example, that a Bajaj Auto announces a bonus every 2 or 3 years because it doles out so much of cash, or for example, Hero has done a great venture. And that time this news would also not come out that some of the good investors that bought, you were pretty much independent. The problem was you couldn't afford them, because the prices of these stocks were relative. It's not the price to earnings were high, but the stocks were more expensive and you could not afford them. So I tried my best to find the cheap stocks. So I would look at a sector and say, oh, this is automobile sector. The general price to earning of the sector is at 20, and there's this company that is at a price to earning of 6, and therefore it is more attractive. And I tried to buy those. But then over a period of time, you realize that many of these cheap companies were cheap for a reason, and some of them ended up being duds, whereas sometimes you were lucky and you just sort of made more money because the company did not end up being a dud, if I was to put it in that way. But it was a lot of experiment. Well, I won't call it experiment in that sense. It was a lot of foolishness initially on the part to chase cheap and not understand where value resides. And over a period of time, those lessons all added up and sort of guided me on what I had to do next.
Right, right, absolutely, sir. Uh, so, sir, like from there till here and now, what does your investment strategy look like? What do you go for now? If you could, I know it's a very broad question, but still, if you could summarize it for us.
Yes, see, the investment strategy will be very different for different people. There are people who are very well versed in the ability to do technicals. I can't do that. There are people who are very well versed to look at cycles and to play cycles such as in metals. I do not have that competence because that requires me to track too many variables which are external, and that requires a lot of time. I cannot be, for example, sitting in front of a screen because of my profession and track what is happening to ruble and what is happening to futures of steel and other things, and therefore it makes my task much more difficult. Also, I cannot control the behavior of temperament of others. So let's assume that today you feel it's a good market day, as in the morning, for example, we had 100-point gap up on Nifty. You do not know how the others are going to react and what are they going to sell on that day, so you may end up being on the wrong side. So what I decided was that I will look at the nature of the business that I am trying to invest in, b, trying to see whether that business is more capital intensive or it is more rewarding in terms of if it's less capital intensive, it will have savings in terms of cash, and that will actually come back to you either as dividends or be retained by the companies for expansion, growth, etc., etc. And then within that started looking at the opportunity size. So if you feel that a company is for example, getting into a segment which is a great opportunity, and the management is doing the right things, then you will start investing in that company. But you cannot do all the investment as of one day, simply because a lot of things can go wrong. So you will put a little bit of money into that company and observe the company over a period of time. Because if the company is to do well, and I will give you examples, then it will have several opportunities for you to top up. So many people are skeptical about topping up or adding to the positions once the stock price goes up, which actually is a big mistake. You should be topping up because it means that the right noise is being made. So I'll give you an example. It is only an example by for the purpose of education. Like the entire aquaculture segment had a very bad past. They were only flop stories and everything had gone wrong because there would be some problem or the other. At the same point of time, a company had come in and it had gone into shrimp feed. But what it was doing was that I had read about Metro Cash and Carry, which was a retail model where essentially you do not invest. You basically tell the farmer that you come and walk in with your produce, and I will see your produce, and if I like it, I will buy it, and therefore I will pay cash for the quality of the produce, and at the same time I'll process it into many other sort of value added services, and then I will provide it to somebody else for a higher value. So what you have done is you have effectively converted the cash cycle into a very profitable thing. Because if, for example, there's no demand, you will not buy, or if the variety is not good, you will not buy, or if there's an onset of a disease, which for example happens in bird flu and the chicken industry, then you will not buy. Similarly, if there's a collapse in demand because of export or any reason, you will not buy. And then I found that their parent was a very large company in Thailand called Thai Food, who basically was controlling the seafood market. They were the second largest player, and had taken in equity, and they were bringing in better processes. So you had a good management, good product. The quality of the shrimp feed was improving. You had a good company. You had a promoter who was sort of determined, and he did not have too many side businesses. And then you'd mitigated the risk by virtue of both the parent technology as also this cash and carry model. So that as an example, and then you asked yourself, do you think this industry can do well? And then you would see that, oh yes, the world is talking a lot about seafood. It is considered to be more healthy. People want to be away from red meats. There are many varieties of uses. It can be stored, and because of cold storage, and therefore it has a longevity as opposed to some other forms of fresh produce. So you took a bet, and then you, as the stock kept going up, and the results came, or the first dividends came, or the earnings came, or maybe the variety of the shrimp changed. In this particular case, for example, they improved the variety. Then you kept building, and of course, then the stock did very well.
Right. So, there is an associated question to this topic. Maybe like we just discussed, you just told us about ki how if the company is doing well, you should top it up. There is also a phenomena like in volatile markets, which are currently kind of going on. इस समय जैसा चल रहा है, तो there is another concept of buying the dip. So, do you believe in that as well?
So what is buy the dip is also very relative. See, it's because it is relative to value, whereas a dip itself may be very misleading. So I'll give an example. And all the people on this chat are like, I'm talking to them as friends, so I'm only trying to be like a friendly sort of thing, not a professional. The problem is that, let me assume today that I want to buy a stock because it is dipped. Now I do not know to what extent the situation in Russia and Ukraine is going to impact in terms of all the commodity prices. So right now, there is an escalated oil price, there's an escalated power cost, logistic is disrupted, supply chains are impacted. If this situation prolongs, then that dip may not end up being a dip, because then there will be a prolonged problem. A lot of companies will report numbers that are not very favorable. Inflation is generally good for stocks, but not at a time when it's disrupting the entire ability of companies to price their product, etc. So in that time, the dip may not be very conducive from a short-term perspective. Over a long-term perspective, if the problems that get resolved. So suppose you buy a stock at say 500 rupees and it dips to 400. To some people, that dip may be very negative, and it may put them off. But somebody else will say, look, I staggered my purchase. I was buying at 500, I bought at 450, and I bought at 400. The value kept going up. And I believe that this is a problem that will resolve. And time, I'm not rushed for time, then it is a good situation. Whereas on the other side, if the sentiment of the market sometimes is such that a lot of things fall together, whereas not all of them are impacted by the negative fact, because there may be certain businesses that are more insulated compared to other businesses, and then you will make your choice and say that, I would rather play that particular card well for the time being, as opposed to sort of experimenting with something where the commodity impact may be very severe. So for example, if you notice, since the start of this year, while I've generally been, talking a lot of bullishness in the markets, in the start of the year, I've actually been very muted on the market. And in all the chats that have come, I've said it is not necessary, or it is not probable or easy for me to even say the direction of the market. Now, that doesn't mean that I, sell my portfolio and run away. That means I have to be more selective. And if you notice, some of the companies where I was talking about ownership in this, in the lockdown, or in this, sorry, not lockdown, this impact of the last few months, they have been more in the nature of companies where I felt that the effect of this turbulence may not be much. For example, the IT sector, to some extent the banking sector. Of course, some of them have corrected, but then that correction is in accordance with the market. So it's not as if you have fallen more than the market. And then certain companies which may be more defensive and may not be completely impacted, and actually are at the lower level of valuation compared to the historical reason, with the companies are still doing well. So those kind of stories.
Right. So, sir, like when you say ki right now you're so you are, as I understood from the conversation so far, you basically invest through fundamentals. And so, how much first part of the question is how much do you rely? Do you at all rely on technicals, even a little bit?
No, zero.
And
Zero.
all right, all right, great. So the other part of it is key. So fundamentals, when you say key, these would be less impacted from this from the current turbulence that is going on. So how do you come? What is your process of realizing it? Is it the exact? So I'm a fan of Peter Lynch as well, an absolute fan. So मैंने भी उनकी कुछ books पढ़ी हैं, but so is it the Peter Lynch way कि whatever you're seeing around you, you analyze it and then go about deciding, or do you have a process around that?
Yeah, see, that makes it easy, because if you are able to see something around you, then you have basically been able to convince yourself more as opposed to some esoteric company where which is which has a office in a part of India that you've never visited, and the business model is too difficult for you to understand, except that some numbers are being reported that on the surface appear to be very interesting. But what you if you buy something that you don't understand, the problem is that when the market shakes up and it corrects, you will be much more worried about that particular stock, simply because you don't know what is happening. But if you are more accustomed to knowing, or you are able to understand what is happening with the company, then there'll be a resilience within you. And one of the criteria for success in investing is the ability to create resilience. If you are able to withstand the winds, then obviously when the winds settle, you will be able to move on. So that is a way of looking at it. So one thing is to see things around you, but also the things around you must not be optical. Sometimes you may go to a market and discover that a new product has been launched, which is particularly happens a lot on the internet and with Instagram and all the business accounts there. But you don't find it sustainable, either because you don't like the quality, or it is too much of publicity happening there but not acceptance. Similarly, it may be possible that the acceptance is happening but it is a fad. There may be a situation where all of a sudden you find that instead of wearing, say, blue colored jeans, some new color of jeans has come and it's torn and it's got some sort of ink on it, etc. But you know that this is going to be seasonal and it will go away. The real test is to buy where the opportunity size for the company is very large, because even if you miss a few points here and there and you get your timings wrong, if the opportunity size is large, you will end up scoring a home run. The problem is that you should not buy those companies when they are already over discovered, when they have already squeezed out efficiency on both top line and bottom line, because then the management has no opportunity on bottom line growth, it only has top line growth. And if it is competing in a highly efficient environment, for example, if you are two FMCG companies and both of them are market leaders, then they are not going to leave any room. And if at that point of time they resort to price wars for any reason, then you're sort of doomed, because nothing really is going to happen. So you have to also look at the fact that you cannot stretch the rubber band so much that it snaps.
Right, right. So another very interesting thing that I found, that I learned from you was that when you like something, when you find a company intriguing, you actually go ahead and buy some quantity of it. So what generally people do is maybe add it to watch list or something, but I think you go ahead and buy it to see its behavior maybe more closely. Is that so?
Yeah,
Because
you see,
you are
when you have
interested in that.
yeah, when you have teeth in the game, now the
Hmm.
question is whether you have one tooth or you have 32 or whatever is very relative. But when you have teeth in the game, there is a greater interest, because when there is a greater interest and you're intrigued by it, you will end up searching. It's like what we call in Hindi as khoj. The khoj is only going to be there if you have an interest. No, if it is only if I have to only research something which is only meant for a cursory 2 minute sort of fill in the blank, then it's not really going to guide. So that is one thing. Secondly, what happens is that when you introduce a stock, assuming that you have only bought a starter position, and for some reason you find that there is reason to sort of build up on that position, then that stock itself will talk to you and say, how come I'm such a small part of your portfolio, why are you not paying attention to me? I'm one of the most promising people in your portfolio and you haven't sort of done much, so you please sponsor me from by whatever means. Now that sponsorship could mean that you either put in more money if you have the money, or you look at some other things in your portfolio and you say, relative to something else that I own, this is more promising, and therefore if it is more promising, the opportunity cost of ownership. See, I think many people, whether you study economics or you don't study, or commerce is not so important, but many people do not study what opportunity cost is. And opportunity cost is the largest sort of trigger for you to do returns which are higher than the market. Whether it is higher by 1% or 5% or 10% is also a lot of luck and the ability to get things at the right time. But a lot of people don't study opportunity cost. So if I buy one of the best companies of India, which is say priced at 100 price to earning, growing at a rate of 15%, the ability for me to do an outperformance in the market will be very muted. Now, of course, if the market cracks and that stock has fallen less than the market, you can have a savior. But the real purpose of investing in the market is to grow your capital. It is wrong to believe that that stock was less risky. Actually, it is more risky because it will stagnate, and over a period of time, companies have compounded and companies grow. But on the other hand, if you've got the price right, then it doesn't matter. See, all these stories that we hear about XYZ company becoming so many times up and all, don't forget that they came at a very easy base level. The guys who've owned them bought them early. They have reaped huge amount of dividends from them. The dividend itself has taken care of the capital, and you know that capital in many cases the dividend was reinvested, and those companies have had a longevity. But today the tools of efficiency are very different. Today companies are not as inefficient as they were at that point of time. A lot of smaller companies, medium companies are also turning efficient. Technology is a big changer. Awareness of customer is very high. The ability to reach out is very high. Globalization is a threat because the world has opened. So there are a lot of new opportunities that will come in, and you'll have to find a stock which is good and also at a good price.
Right. So I couldn't agree more, sir. Matlab, of course, so the about the opportunity cost and the thing that we just discussed. But इसमें एक और चीज what happens at least with me is there is a certain kind of psychology maybe involved there कि कुछ I buy, let's say I buy something that I believe in कि let's say Tata Motors है, which I feel कि in the coming few years it will have a very good impact and EV sector maybe है and for so many reasons it's gonna do really well. बट उसका कहीं उसका बीटा हाई रहता है टाटा मोटर्स का, वो एक शार्प राइज आता है, शार्प फॉल आते हैं, अभी भी रिसेंट में भी वो आए ही हैं. एंड देन वन, मतलब वो थोड़ी सी एक साइकोलॉजी रहती है कि यार चलो कुछ बना है इसको बचा लेते हैं कहीं और गिर ना जाए. सो हाउ डू यू, वुड यू हैव एनी एडवाइस फॉर पीपल लाइक मी कि वो कैसे, हाउ डू यू बिल्ड दैट डिटर्मिनेशन, दैट ग्रिट की नहीं होल्ड करना है तो करना है.
See, without being so specific on stocks, but if the example that you are giving is an example of a business that requires a lot of capital to grow, and that capital will be required for both, that is to grow as also to prevent the company from becoming obsolete. You can see yeah, all the companies in US that are into the auto sector are have to spend a lot of money first of all in order to survive, because of the onset of technology and the disruption, and then this new class of vehicles that keeps coming in. So when the company's money is going to be used substantially first for survival and then for growth, the task of investing becomes much more difficult and the company becomes more cyclical. Although if you get the cycle right, you can still make money. Whereas in many other companies, this sort of problem does not exist, because what they're doing is that they're creating an infrastructure around themselves. That infrastructure is either around their product or their or a new market that they're creating, or the fact that the management itself is scaling up. Let's not forget that one of the largest assets of any company is not the financial asset, but the management that causes that financial asset. And if you find that the management is becoming much more focused and is learning with wisdom of growth, I mean, for example, if you read the book on Havels, you will define that how the company has evolved from the time when it used to be just a wire company to the level that it has reached today. So if you happen to find such opportunity, and then at that point of time when you had seen, I think when the IPO came, the stock was maybe about 30 odd rupees. And I remember that there used to be a company called Ajanta Mercantile, which used to be their own subsidiary, and they had to literally go and beg people to buy the shares, because even if they did not bring the adequate amount of shares under what is called as the friends and family and promoter quota, then it would look like the company promoters themselves are not serious. Then you find that when the opportunity is great for that company, and the movement is happening from low quality wires into high quality wires. It is a bet on human safety. When you look at television ads where they show that somebody is basically going to touch a switch with naked hands, and those switch can have problems. The traditional switches in houses when we were all kids, they would all trip, and sometimes there would be short circuits and other things. You look at the size of all that, and you find that there's great opportunity. Same thing happened with an Astral Poly when they came, and you said that all the pipes will be converted. They're easy technology, they are aesthetically more appealing, they're cost wise more effective because of longevity. And hotels are resorting, companies like Oberoi Hotels and others at that point of time were giving orders to Astral, because the home segment hadn't really taken off that point. And you say it is inevitable. Same thing happened with the sanitation drive, when you felt that how can it be that the country is prospering, and you go to the most sophisticated market of, say for example in Delhi, you go to Connaught Place and say but there's no washroom. And you can go to you can talk about metros and you say there's no washroom, and all you say, but what is how can it be possible that the humans who consume food and will need to go to the washroom will not have access? And then you ask yourself this question: do you think that there you'll put in very high quality toto fittings or some international grohe fittings, or will you put in some basic fittings that come in from, say, companies like Serra at that point of time? So then you evaluate and say, oh, is it going to be Serra, or is it going to be Hindustan, which used to be I think whichever HPCL, whatever it's, no, not whatever, HPIL, I forgot what the company is called, but what Hindustan's sanitary ware. And you come and say which is a better managed company, and then you have reasons to sort of discover that, and then you take a bet. And if the story is playing around again, like I said, if the stock is to go up 100 times, so whether you came up, sometime what happens, you buy a stock at 10 rupees, it goes to 20, and you say, no, bahut badh gaya. Then the 20 becomes 40, and 40 becomes 80, 80 becomes 100. Many people keep moving in and out, and they, all the returns that are they're supposed to get actually get converted into tax. Second problem is that temperament, we are so anchored by price that when we see it go up, we say, नहीं नहीं, हमने 30 में लिया था, अब 100 हो गया, अब नहीं लेंगे, अब गिरेगा तो लेंगे. वो गिरता ही नहीं है, because वो कंपनी में भी potential होता है. So that's the other thing that you have to see. And then if you get a few of these high return stocks, your portfolio is done.
Right, right, absolutely. Sir, generally, if I may ask, what does do you believe in targets? So I have
Never,
often found that.
never,
Right.
because that is undermining the management. That is like,
Hmm.
I find it ridiculous that somebody
Hmm.
should, like a person looks at a company and says, buy it 500 rupees for a target of 600. So the
Hmm.
management, if you ask were to reverse it, what is it
Hmm.
the management will do in order to reach 600? So you'll say, you know what, they're going to be producing and they have an inventory that will be sold, and that inventory will be converted into its balance sheet, etc. So what if the
Hmm.
company comes and says, now by after conversion, the market awareness has become high, and my next
Hmm.
order is going to be bigger, or that I will get economies of scale because my order intake has become bigger, or all of a
Hmm.
sudden I'll be able to innovate the product like some of these companies examples that I gave, and therefore I will be able to sort of grow a market. Then what will you do? So what will the target do? And tell me something, in my entire life, if you look at any stocks that gave you multiple times returns, it broke all the targets anyways. So the targets have to be restated again, 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 again. And how will it help? Actually, look at this. I'll give an example. And today I was having a discussion with one of my other investor friends that in some of the cement companies that have corrected today, and have corrected because of obviously the impact of the hike in the impact of coal or power or fuel, etc., the FIA holding actually has gone up even in the last quarter. So the FIs themselves felt that these were defensives, and they will bet on make in India story, or they'll bet on infrastructure because the budget spoke about infrastructure. But all of a sudden, some variables change because of the reasons that I articulated, and they sort of change their mind. And then you are stranded against a wall where liquidity is being converted into a complete sell-off mode, and you don't have the ability or the means like a large institution to sort of buy the adequate quantity, and your portfolio for those stocks suffers. That is why you need to construct a portfolio, because you'll always have certain, it's like looking at a class, you'll always have some students doing very well and coming first, second. Now the guy who's coming first or second doesn't mean that the guy who's coming 23rd is not going to one day become an outperformer. You've heard so many stories of people who dropping out of schools and colleges who set up the most unicorn companies. So be a little more pragmatic about your holdings, because बहुत सारी companies के अच्छे दिन ना अलग अलग टाइम पे आते हैं.
Right, absolutely. And especially, I guess fundamentals may you kind of have to have that patience. Ki if the fundamentals are good, it will someday grow, if not immediately. So,
No, that is why the returns are can be exponential. No,
hmm,
when you
hmm,
look at a company, there can be a time when you can own the company for year, 1 year, 2 year of
yeah,
underperformance. Your patience will be tested, but you
yeah,
don't know that in those 1 2 years, the management may be working very hard to do a
hmm,
transformation of the company, and then all of a sudden the company here hits bingo. And then also, the markets move in euphoric phases. So when
hmm,
the good happens, and everybody believes that that good will last in perpetuity, and there's a crowding. When bad happens, everybody thinks that this is the end of the world, and everybody wants to dump the stock. So and like on Twitter, so many people ask me this every day. They said, if FIs are going to sell every day, then who's going to buy? One day the DI money will get over. It doesn't work like this.
right, absolutely. Right. So, how about the other side of the equation? So, sir, there can be no targets, but what about risk management? Do you keep any stop losses or any other, like, do you keep checking on the story time and again कि क्या चल रहा है उसमें? How do you manage your risk?
Yes, so I don't do stop losses because that for me will amount to trading. And also there can be unusual situation, like there can be a situation where there is a flash of a bad news on television, or sometimes even a mistaken news, and a stock may react that day, and all of a sudden somebody may be waiting for a dip because he wanted to buy it, or he was not getting liquidity at a higher price, etc., etc. I mean, as an example, you have seen this historically, and again I'm only sharing it as an example. Every time HDFC Bank says that our FI limit is open, the stock moves up. In like it doesn't even take a few minutes, because all of a sudden, if that time everybody wants to buy it. But it's a different thing when the markets are the way they are, and they just basically feel that because it is liquid, they and ICICI is liquid, and State Bank is liquid, or XYZ is liquid. They just feel that, oh well, let's tinker with and remove our and balance our portfolios in that way. There is a price to liquidity in the market. There is a price to opportunity in the market. So I don't follow any stop loss. My point is, if the company is growing, then yeah, the buyer will come, and the earnings will come, and the valuation will come. Of course, if the company is growing but it is heading towards a cliff because of disruption, or because of the emergence of newer technologies, or new business models that could impact it, or are likely to reduce its margins or its earnings, then you will have to be more tapered and say that, look, I'm not going to buy more, but and I will therefore diversify. And I'll pick up, I don't know which is the best apple on the table, so I'll pick up two or three apples to see and bite and see which one is fresh, and then over a period of time your portfolio will be self adjusted. So diversification is a clear answer to me, for me, to sort of reduce the risk, and to let the growth of the stocks decide their weightage, rather than for me to decide weightage today and be so self determined that as if I was going to be absolutely right on day one.
Right, absolutely. So that kind of gives me another clue about something that I wanted to ask was, diversification versus zoning into a particular sector or stock or something. But that also, I also have a related question. What do you have an ideal portfolio size? Like how many stocks should you be invested in? Right, from going from Peter Lynch, ke to he was famous for having thousands of stocks in his recommendations. But do you personally keep a limit on the number of stocks that you're holding?
See, again, the answer, my answer may different from somebody else's answer, but there is a difference again between one individual and another. So let me assume that tomorrow morning, I get 1 lakh rupees as an example into my bank account. Now, tomorrow morning, should I look at which is the most efficient stock in my universe to buy, or should I look at my portfolio and say that no, despite efficiency being somewhere else, I should basically buy what I already own, just because I want to go and tell the world that I had such great level of conviction, which anyways is not subject to me but to 99.99% other people in the market deciding. So you will basically, as a good thinker, you are going to put your money where you feel that the opportunity cost is the best. And if on that particular day you find the opportunity is good in something else apart from what you own, then you start buying that. See, what I do is that for me every unit of money is treated separate. So if every suppose I'm putting in 1 lakh rupee, that 1 lakh rupee tomorrow morning, if I was to keep in the bank, will earn me say 6%. If I invested in the market in an opportunity that I find good, which is going to give me 20%, is different from a stock that I may already own, where I may be sitting on such a low base that the dividend realization may be in my favor, or the risk profile will be in my favor, or the stock has gone up so much that it's become a larger part of my portfolio, and I cannot take an undue risk of just adding to that, because at some point of time, if something was to go wrong, then I will slip a lot. So there is an opportunity cost in that sense, and I gauge that every time, and I try to sort of reason out. Now, when the market, like let's, and another thing that is supports that is that markets revert to mean. So you'll have some sectors doing well, then another sector will pick up. If you just look at the market in the last few years itself, it has become so difficult. Sometimes chemicals go up, sometimes now banking was performing in the last few days. In between, we had rise of consumption stocks before everything else. Then IT was performing, then large IT was performing, then mid IT was performing, then platform companies came. So you will find it very difficult like this to keep sort of regulating your mind and shifting from one to the other. So you look at the the best opportunity. And similarly, when you look at your portfolio, like as an example, why did I sell off my position in a platform company? Because I thought that, look, from the value that I entered to where it reached, the stock price had moved way ahead of earnings. If the stock price has moved 5 times and the earnings has only gone up once, and then you feel that is the competition setting in. And many forget about the competition of platforms. Even banks themselves are becoming platforms both HDFC Bank and ICICI Bank are becoming platforms. Then there'll be other forms. Somebody who's running an offline store will say, now I'm doing online and I've taken the service of a IT company and I've sort of moved up. Then you feel that a lot of the things that are around apps may become more generic, and therefore the uniqueness of that business model may be impacted. Let's also not forget that when there is a greater level of education in the sister society, and the society starts accepting a transition, then the level of migration starts slowing down. It is very high when the acceptance is low, because the opportunity size is very high, and it starts reducing after some point of time, because after that point of time everybody sort of moved in, so the competitive pricing of that particular model also starts getting impacted.
Right. Right. Absolutely. Sir, if I may ask, coming to the context, the current context, what is your general strategy around such times when there is high volatility or turbulence in the market? And जैसे कि अभी हम लोग एक छोटा कहो या I mean it's relative but still एक fall देख रहे हैं अभी हम लोग. So do you change anything in your strategy, or do you trade like irrespective of what the market conditions are?
Yeah, of course. Like I just told you that while I have been a perennial bull since many years, and particularly when COVID onset came, and that point of time, I articulated also the sectors that I liked, and I obviously invested in them. The point is today, I must admit, without any sort of double thoughts, that it is not easy to think about where the market is headed for, because the factors that are can impact the market are not factors that are in my immediate understanding. And even if I try to position my mind very hard and say that no, I'm going to be very headstrong in the fact that no, I have to be right and the opportunity has come in and over a long term the market sort of does very well. No, it doesn't, because market does well is very different from the fact that scripts may or may not do well. Let's not forget that the constitution of the Sensex repeatedly changes, and so does of Nifty 50, and therefore what you see in Nifty 50 may not be necessarily reflective of your scripts. There are so many scripts that were part of Nifty 50 that are out today. Similarly, there may be very beaten down sectors that may revive, and there may be sectors that may be in trouble. Like, look at the dichotomy. On one side, you have a PLI that is supposed to kickstart manufacturing, and a lot of people are talking about that opportunity. But on the other side, now you don't know what this havoc of commodity prices is going to do at the end of the day. If you increase, if it was so easy for these companies to pass on the prices, then they would have not seen erosion of margins. Now, I was today discussing with a friend, and I'll just leave you with this very interesting thought, that on one side we say cement is a cartel, and right now on the other side the market is punishing cement companies by saying that no, you will not be able to take up the prices. So which is right? Is cement a cartel, or will cement companies not be able to take up the prices? And the last quarter you saw that some of the cement companies actually saw erosion of margins. Now, how much is this is into the price? Because some of the leading companies, the largest three or four names in cement and maybe more in mid caps, have already corrected 20 to 25%. So, do you find that there is value there and it will revert to mean, or do you find that there's going to be a prolonged sort of, it can stagnate also. So you may buy a company and for 2 years it goes nowhere because the earnings are impacted, or all of a sudden the earnings look, the stock looks expensive. It's a call that you have to take. The difficulty is, like right now, before this chat has started, crude has cracked by some $6 to $7. No, for whatever reason, just assume some Iran treaty is signed, and tomorrow or after 3 days, the crude comes to 100. Will we forget all this and we'll see a rally? Perhaps in these beaten down stocks will outperform some of the stars by a huge margin. But if we don't see it and it sort of remains where it is, or it goes up, then we don't know. We'll have to sort of, therefore, you'll have a diversification, no? Because then you say that, oh, my. So what happens today? The market was down some, I don't know, through 250 odd BSC points or whatever, 60 odd Nifty points. But if you see, and mid caps were in the morning, they were up. Eventually, they closed sort of flattish. But the small cap index was up some point 0.8, 0.7 or 8. And if you go to the website and see what is the small cap index, it actually has a lot of credible mid cap companies. So why, when you're diversified, you come and say it's all right. Today I lost money on XYZ, but I made money in Y, and your mind is of a winner. See, don't forget, the reason entrepreneurs succeed in their business is because they come to a board and the board guys keep telling them, yeah, let's expand. Let's look at new territories. Let's experiment with the product. We have an R&D team that is working with us. The sales guy will say, don't worry, I will go out in the field and get the sales. There is a self motivation system. That self motivation system must apply to your investment also. If you feel motivated to invest, you will find lots of opportunities. If you feel defeated for whatever reasons, then even the best opportunities will pass in front of your eyes and you'll not be able to invest.
Right, right, absolutely, sir. Sir, while we're on the context of diversification, there is a line of thought that new investors should probably stick to going directly with maybe ETF, Nifty ETFs or Nifty Bs or something like that. So, do you have an opinion on that?
See, first of all, new investors should do what is of highest amount of safety, and there is obviously greater safety when you are trying to buy the Nifty for simple reason that historically that is done well, and if good companies, whenever they reach a threshold limit, will be inducted into that, and bad companies, because of stagnation or because of deteriorating financial, will move out. So in that sense, they will do way better. The real thing is that if you actually read certain books, and I will share it on Twitter this evening. It's a very different thing to buy the index and to buy an ETF. They are not the same. An exchange traded fund may, for example, have derivative positions, and to that extent it may suffer from a loss when the nifty corrects, because they may be replicating it by virtue of derivative, and this has actually been written about in a very good book that I'm reading, and I will share that, like I said, today. But when you read about this, you'll see, it's a different proposition. So a lot of ETFs in the world actually have hedges, they have derivatives, and they have a lot of other things. Even some of our funds in India, who, if you notice, if you look at their structure, while they claim to be owning stocks, they also have derivatives. They'll say we've hedged it against derivatives. So that derivative loss, A, increases their cost of operations, and B, it may not augur well if the market goes against them. But Nifty buying pure, say, like if Nifty, for example, buying it like you were buying a stock is a very different proposition. Yes, so if a retail investor does not understand the market, he can buy Nifty, and anyways he will do well, because even if somebody is outperforming in a short run by virtue of a certain sector, there will be sector rotations, and only some people will be able to latch on. And a lot of people, do not know when to sell. They get so obsessed with the stock. They buy a stock at 100, it goes to 500, 600, 700. They just feel that now it's just such a great stock that the rest of their life they don't want to sell. And when the stock starts coming down, then that 800 becomes 600, 500, 400, and then they sell. So you must also balance your selling, not just your buying.
Right, right, absolutely. Uh, so next, next thing that I want to ask you is कि as matlab, as somebody who has been in markets for a while, the of course we covered it briefly that of course protecting your capital is one of the most important things. But if you can give me three maybe pointers that one should do or should or must not do in the market as a new investor.
No, see, I can give you those pointers based upon what I have seen in my investment career. But like again, it doesn't mean that I will not make mistakes tomorrow or day after and times to come. That is the uniqueness of the market. That is why the market is not so easy to decipher. It is a basically a call that you have to take on many angles. But one of the mistakes is that don't buy things that you don't understand. Simple. The first rule. I mean, at one point of time when I had started investing, I was, I was also buying IT companies, and I would get very fascinated when I would see in the Economic Times an article will come that this company has gone to US and has bought another company, and then another company, and I would just think that they're becoming so large. But in reality, it creates such a complex balance sheet that you forget to understand what the company is really doing. And you have too many chapters to fall back on to understand, which makes it very difficult. Secondly, do not buy a company which is appearing too frequently in the media to talk about of its stock price and making very lofty projections, giving ads in the paper to say that we've had the exceptional year and now it's going to be really really fantastic, and we'll become XYZ. I just, as an example, had tweeted about this, SEBI crackdown on a particular company, which, if you look at the history, and I think CNBC had covered it, and they'd shown this, that that company has changed its business model and name only 6 or 7 times. Every new sector that comes, they just change the name according to that, and they sort of pitch it. And then all these news that comes out that XYZ investors have bought that stock is also of pure marketing. But don't just buy a stock because somebody else has bought it. They may have a different reason. They may move out without telling you. If you remember, when the Yes Bank saga happened, there was an article that some guy from some country was going to buy that stake, and then you discovered by googling that that person was not even listed anywhere in the world, so you didn't even have his net worth. And then a news article came out that Mr. Jhunjhunwala had bought the stakes, and everybody said, "Oh, you know what? We are very confident," to discover that he probably offloaded his stake in just 1 or 2 days. Or maybe when he bought it, he hedged it in futures or God knows what, but eventually his shareholding, his ownership in that company disappeared. So you'll be stranded. So because you are basically trying to sit in somebody, a stranger's car, not knowing where the car is going, who is driving it, is he rash, is he is his eyesight good, does the car have brakes, etc., etc. So that is the second lesson, and the third lesson is always stagger your investing over a period of time. Even when you're selling, if you're not sure, there's no harm if you sell a little bit, then wait, and then sell a little bit, etc. Because you will get that opportunity. The thing is that if you act at one point of time, there's always a sense of regret that may come in, that I sold too cheap or I bought too expensive. And regret is not good for the mind of an investor. I mean, if you learn from the regret, it is very good, but regret by itself isn't.
Right, right. That's very well put, sir. Right. So moving towards one final question of the day, and that's it's slightly longer one. I absolutely love the way you, everything that we discussed, everything that you gave us. You had for quite a few of those things, you had some examples. So one final question, if I may ask you, do you have any sectors or even stocks in your watch list right now? And the reason I'm not asking it for any recommendation or buy sell, I want to understand your process through maybe an example. And so what I'm asking is any sector in your watch list right now and the rationale behind it, a little bit of rationale behind that. So if you
Yes,
can
see,
give us a few, yeah.
the market is meant to be enjoyed in two ways. This is my thinking. One way is that you've invested in the market and you reap the benefits of what you own. So every single day, the market literally throws a report card. Now, well, many investment books actually say that you should not be looking at your portfolio every day. This is not what they mean. And trust me that as a lawyer who understands interpretation quite well, this is not what they mean. What they say is that you should not be looking at your portfolio every single day to decide that today I will sell this company because it is 4% down, and today it is I will really like it because it's 2% up. But there's no harm. In fact, if you see the documentary on Warren Buffett that is showing on the I think Netflix or Amazon, even there Warren Buffett says that he carries three different levels of change in his car, as in change means coins in his car. And if the market is up, he buys a more expensive burger. If the market is not doing up, he buys a moderate one. And if it is not doing very badly and he's losing money, he buys a basic entry one. So he also makes it fun and he's talking about it. So there's no harm in looking at your portfolio, because at the end of the day, it is also an achiever's portfolio, in the sense that you look at your portfolio. If you've done well, you feel good. If you've not done well, sometimes you realize, what is it that I'm doing wrong? Now that day you may not be able to come with something conclusive, but if for over a period of time you discover that the trend is continuing and repeatedly you're doing something wrong, then you may be sitting in a wrong level of stocks. So there's no harm at all in looking at that, at your portfolio. The Sorry, I forgot, what was your question?
So the question was that any sectors or even stocks that
Yeah,
are in your
so
watch list and the
yeah, so
rationale.
I always correct now. So I always have a list. For example, even right now, so I was saying you enjoy the market in two ways. One is what is doing in the market. The second part is like right now, suppose I'm having dinner, and so I don't watch too much of television. I like to read a book, or if I like to listen to music, or sometimes even go for a walk or something. My mind will always tell me that these are some companies that are good. Now, those good companies come to my mind when they correct more, because of the reason that when they were not correcting, then usually my portfolio would also be doing well, and I really didn't have to do much, because you sort of you're on a good ride. But when the correction happens, you come and see that, oh, between two level of companies. certain companies have corrected, high quality companies have corrected, whereas some of the lesser quality companies or uncertain companies or companies that are yet to prove their credentials have not. So, as an example, yesterday I sold off one of my small cap stocks because it had moved up substantially. Now, what has changed between January and now for the stock to more than it went up, I think 2.5 times in just 2 months? Nothing. It's not as if the company had bagged some great order. It's just that it got discovered. It moved from SME platform into an NSC platform, and then there was a frenzy or whatever. So if I ask myself that did this company justify a 2.5 times rise vis-a-vis some of the higher quality companies that are falling, almost all of them in that sector, the answer is no. So as a smart person, I'm supposed to use one currency for the betterment of the other. On the other hand, if I find that the reasons for that movement are justified because the product has done well or because they've bagged a good order and all, then I don't need to do anything in that. So I have a list ready. Even tonight, I will make a list without looking at anything. I don't have to look at a screen. I just make a list of 7, 8 companies, keep it in my pocket. If the market opens on a bad day and I find that some of these good companies are getting caned, as they say in some of the schools, then I will buy them. Or on the other hand, if I find that some of my stock has reached a level where I should exit, and therefore I have currency available to use, then I will buy it. On the other hand, if nothing happens, then they'll remain in that list, and that list keeps changing. So I make it digital in a digital form on my phone or in my whatever iPad or whatever. And if I find that no two companies that I put there have moved up, because let's assume the market moves up 3% for the next week and these stocks are up 10%, then maybe they're out of my list for the time being. So I don't have to strain myself literally to think that I have to, when the market is not doing well, so for whatever reasons, or is doing very well, I don't have to strain myself to think that अब जबरदस्ती का मैं ढूंढूं और जबरदस्ती का कुछ shift करूं, and that anxiety should remain, etc., etc. It's very very clear. In fact, sometimes I send my broker an email at night, and I use multiple brokers. Sometimes I send them an email at night only कि कल सुबह ये खरीदना है. तो मैं बोलता ही नहीं कि ये मार्केट ऊपर होगी नीचे होगी, फिर डाउ को क्या होगा और रशिया में क्या होगा, अगर मुझे खरीदना है. और अगर मुझे बेचने का मन कर दिया, then I decide I'm going to sell it. I just say please sell it. I don't even give him a price.
Right, right, absolutely. सर एक और क्वेश्चन मेरे को अभी फ्रॉम दिस कॉन्वर्सेशन इटसेल्फ केम द लास्ट सेगमेंट. So of course we talked about ki sometimes valuations have to justify themselves kind of thing. So just a while back there was a euphoria around IPOs. So अभी तो वो कुछ शांत हो गया I think, but then there were crazy valuations and people were buying just for the premiums and things were happening. So do you what is your thought on these companies जो कि as of now they may be loss making, they may not have fundamentals, मतलब they may have fundamentals, they may not have, but then as of now they are not profit making, but they are promising ridiculous amounts of growth in the coming years. So do you have a take on that?
Yeah, see, if each business model has to be seen from a different perspective, and luckily here, I was on the side which had appeared on television and said also that I do not think that some of these new age IPOs will list well, although they were quoting at grey market. See, if you look at the Twitter, many people were searching for grey market premiums and they were filling up those forms as if it was a lottery ticket, and that is not the basis of investing. That's not how investing is done. Now, if you look at I had written against, even on Twitter, I wrote multiple times against some of these companies. Suppose one of these companies was into the business of issuing policies. Now, on one side, you were so fascinated by their policies, but on the second side, you realized that the insurance sector was itself struggling, and that is already materialized now in massive corrections that have happened in many of the insurance stocks. On the third side, there was a bank which had otherwise a sort of a turbulent time going ahead, like which because of many issues, that is IndusInd Bank. But IndusInd Bank itself was issuing more policies or getting more income out of the business that it was doing as compared to some of these companies. So you have to look at it from a holistic perspective. Now, if you look at a company that is into buying and selling of cars, they at least have in that sense, they at least have a business model which is way better, because it is not such a whimsical model. But then you look at the thing and you come and say, but Mahindra has its own cars, Maruti has its own cars, and tomorrow you don't know what is really going to happen, because suppose a deadline comes that you cannot have a car for more than say 10 years, which has already happened in some parts, and all of a sudden there'll be a frenzy. Where will these cars sell? because it's not as if somebody can buy them and they're going to convert it. Either they were into the business of saying, okay, we'll take the cars and we'll convert them into some metal and recycle, and therefore we've got some value added service, etc., etc. But the point is that you really don't know. So if the car itself has no premium left, or because there are no buyers, it has very little life left. Then what will happen to this business model? Now, if the business model comes, valuation comes attractive, then you will say I'm willing to risk it, because now there is a lot of it's lot in the price and in the earnings that the companies will have. But if the business model is confusing and you keep launching one thing after the other, after the other, after the other, then how will it sustain? Because the question is, don't forget that even the old age economy companies, who are actually the customers for a lot of these new tech business models, will adopt their own business models. You have seen it in the case of Hindustan Unilever, and how Hindustan Unilever has transited to e-commerce, and it went into direct to home and other models. And similarly, there will be so many companies tomorrow. It's possible I'm able to block to even pick up 2 bags of cement by going on an app and tapping. Then what will I do with the rest of these services? So the question is, you have to see these models, and you're wrongly comparing it to US, because some of the companies in US, which we get enamored by, and we think that we'll find the next Amazon and we'll find the next Alphabet, they are actually global companies which at a very low part of earnings, they're at 18 or 17 times earnings, and they're still evolving one product after the other. So they're able to adapt. For example, if Google today says that the map is free, it is able to get revenue from AdWords. And by the time they say that the map is paid and they've launched another service, then they'll say, no, we have been able to, one thing is compensating for the other. So their business models are very different from the business models that some of our new age IPOs have. And the problem now is that the new age IPO has changed the mood, because now everybody discovered that some of it will also be overdone, which means that some of these companies will reach a price, and it's possible some of them have even reached a price when they may become attractive for some reason or the other. But we will now have such a bad flavor that either they will be ignored, which is why I said market reverts to mean, or they will impact other good companies. After all, there may be other companies in the IPO sphere that are listed, for example, companies in a chemical space or a pharma space, that may be also getting rogered, because now all of a sudden you're told that all the IPOs were bad, which is not the case.
Right, right, absolutely. That was great, sir. Thank you so much for enlightening us with so much of wealth of information. If I may have one final leaving thought from you for our audience, for me, for everybody, that we should keep in mind always.
See, the one recommendation that I have for everybody is that it is always better to be an optimist in life than to be pessimist, because for reasons that it makes you feel, first of all, believe in yourself, and secondly, whenever problems come, which will come, COVID was a problem, your health could be a problem, your career could be a problem, something. The optimist mind is will always believe that it will sort of resolve, and over a long term period, this is how the trend of the market is, that it does resolve. The only difficulty is that how do you manage your cash flows in the interim? So sometimes, let's take an example, that suppose you're very bullish on the market right now. So like for example, and you're, or for whatever reason you find that the correction is a great opportunity, then you, even if you don't own 100% of your money and you put in 90% or 85%, you will do substantially well, because that money itself will grow, and will become a larger chunk as compared to the cash in hand. On the other hand, if you're bearish, you don't have to go to zero. And I don't understand this on Twitter when somebody comes up and says, you know what, I'm a long-term investor. I quote Warren Buffett and all the time, and Charlie Munger all the time, and all of a sudden, when the market cracks, out of 15 stocks, I have sold 12, and they proudly put up those names. I think they're just fooling themselves, because those they had no idea, except that one market correction rattled them, and they have got into cash, and they will never be able to decipher till they find that certain sticks have gone up, and then they're latching on and catching a sort of a running train or a running bus, whatever terminology you have. It's a different thing that a person says, look, I own 1,000 shares of a company, and the market, I'm a little worried about the market, or I feel that the valuation has gone up, and I have pruned it down to 800 shares or 600 shares, etc., etc. That is fine. That is logical thinking. So do not believe that it is going to be all or nothing. I mean, I'll give you an example. If Russia resolves, the market could be up 2,000 points in a single day. And if the market continues the way it is, well, some people are saying that the market has corrected a lot, 25%. I think actually what it's doing is giving you a painful death, which basically means it is correcting small, small, small. every single day over a continuous period since the last several days. So the question is, you cannot be subject to slow poisoning, or you cannot be subject to abrupt. And also remember that in order to make money in the market, there are just 30 days, just 30 days in the year where you have to be invested in order to get all your returns. Actually it's 28 or something, but I'm just making it easy. Now which when is the 30 days going to come in all the 365 is never going to be known to you. So you will have to figure out that which are the days when the market will have this 2000 point rally that will make a. Last week, I mean, just look at it. 2 weeks back, you got rogered. One of the days, I forgot, the market was down and the mid cap index was down, I think 5% in a day, more or 5.5% in a day. The next week, the mid cap index recovered 4.5. How would you ever be able to assess this? And until and unless when you nobody has the ability to do this. And yet, when it went down, the FIs were selling. When it went up, also the FIs were selling. So really, what happened in between, nobody really knows. So be invested and remain. And if you have sources of income, for example, because of your profession or whatever reasons, dividend income, and you have cash flow, then keep deploying them slowly. Because the guy who does this over a long term period usually ends up making a lot of money, as opposed to somebody who says, "No, I'm going to do it all off in one go."
Right, right, absolutely. Sir, this session has been one of my favorite ever so far, and I'm sure I have been totally engrossed in it. But and yet I will need to listen to it again, so I can absorb it fully. I'm sure I cannot absorb it all in one go. So thank you so much for so much of, like I said, wealth of knowledge, wisdom, and guidance. So, once again, thank you so much for joining us, taking out time to talk to us and helping us in this world of stock markets. Thank you so much, audience, for sticking with us for the entire hour. And I really look forward to learning from you much more, once again, to have you on the show and learn from you, sir.
My pleasure. But I thought you wanted the audience to ask at least a few questions. बेचारों को लगेगा यार
Uh,
हमको उनको बोलने ही नहीं दिया.
Definitely, sir. I would be happy to. I mean,
So you
I'll
can
add a
do
few.
about 4 or 5 questions, because it's always
Yeah,
fair to somebody. We should respect, their time also, and
yeah.
somebody can ask. And of course, if the questions are not happening, then we have many opportunities in our life. Hopefully,
No, no, we have a lot of requests lined up, sir. In fact, so I was I wasn't sure if you would have the time for questions, but I've added a few people already. Sham, sir, are you there with us now? Uh, Bharat, sir, Sham, sir, I've added you. Yes, Bharat, sir, are you there?
Yeah. So can I go ahead?
Yes, sir, please ask your question. Yes, sir.
Yeah, thank you so much. So, Safir sir, thank you for giving this time. Actually, in this bear market, we need you more than in bull market. And I have been keep listening you since long. You started your space.
Hello.
Yeah,
I
the,
just want to know, like everybody's talking the peer.
hello.
yes, sir.
Yeah, so my question is on the valuation and the exit. So you just mentioned you invested in some SME companies, and then within 2 months the valuation went up to 2.5x, and then you exited on based on the valuation. So that would be the case that it was undervalued, non-discovered, but after this entered in the industry platform, it came to the limelight, and then everybody jumps in. So, did you decide that on just because it returned 2.5x in 2 months, or something also happened with the management or the company? Because a lot of stocks gives a good return, but we keep on invested in it just to thought that in coming days or months it will remain jump from the small cap to mid cap to large cap. So, how the decision basically on the exit taken by you?
See, sir, that decision was relatively easy, because if you go back into the market in, say, January or December, whenever I would have bought it, that point of time, the market had not corrected. And therefore, at that point of time, relative to the market, and you were running out of ideas, and you found an opportunity in a smaller company that was otherwise doing very well. Now, what I'm trying to say is that in the last 2 months, there is nothing that has changed vis-a-vis that company that should give it an added boost vis-a-vis, say, for example, the top three leaders in that sector. It cannot be, as an example, that if Unilever or Procter and Gamble or Godrej or somebody are struggling, the smallest company will turn around and say, "Look, I it's one thing that something has happened. For example, like I said, they've launched a product, or they are disrupting the market in some way, or they bagged a very large export order. But if nothing has changed, what is happening is that you're bringing down the leaders, and you're saying that the lesser known companies who have yet to prove their record and which were otherwise cheap in December, now all of a sudden are more expensive because they moved up with nothing changing. So when you're, it's like you look at your plate and you say one part of my plate has got certainty, which is the established companies correcting. See, look at it. If you look at some of the companies and they've corrected 20-25%, if you look at those companies and say 20% or they say 20% of the market cap is gone, and the second side of the plate is more uncertain companies that have moved up 250%, then what is happening that you're basically getting a currency arbitrage. It's like your dollar rupee rate has changed and something has become much more favorable for you vis-a-vis. Now you can either decide to continue, but when the market corrects, it will not be that only the large companies correct. If today you say that, say, suppose the top banks have corrected, it cannot be that the banks have corrected and the second level banks will not be impacted. It has to have there'll be a wave effect. And in that wave effect, when selling happens in companies that are small caps, the liquidity supply can be so large. I think one of the persons has his mic needs to mute. Yeah. So one, the impact can be so severe because आप 3 सर्किट लगा दोगे उसके अंदर, तो उसके बाद तो किसी का इंटरेस्ट भी नहीं होगा. So you have to take a call. You have to, like, it's like a tarazu in your hand that you have to weigh. Yeah, it's even likely that I, like, for example, if I was to look at my portfolio tonight, which I'm not doing, I may look at certain companies and say, "ठीक है, what caused me to make so much of money here?" Sometimes I will not be able to answer myself, and I'll say, "Okay, let me look at some of the leaders and what has caused them to correct so much," and I'll say, "I really don't have an answer." So what is better then? It is always better to sort of move towards, in uncertain times or unknown times, to move towards more certainty, and in more robust times to move towards more disruption. Not I'm saying disruption. When there is boom, companies that are disrupting will do very well. When there is a lull, companies that are stable will do very well.
Hello.
Yeah,
Hello.
Hello.
sir, if may allow, if I may
Hello.
allow just one few seconds. Hello.
Yes,
Safir
sir.
sir.
Hitesh, sir, please ask your question.
Yeah. Good evening. I just want to know, like everybody is talking the PLI scheme of the governments, which will finally start giving the results to the company after 3 to 5 years. How you see the Dixon Technologies in that reference?
Sir, I won't answer specific on the company, but the PLI is a very good scheme. If you want to understand it better, it was interesting that if you pick up the newspaper today, Mr. Sunil Bharti Mittal has given a very good interview where he is saying that all these years in India he has been very skeptical because always talks happened about this happening and that happened and there was no follow through. But he now feels that the changes that have been brought on by PLI and the sort of fast track way in which the government is trying to do certain things may actually open a huge opportunity for India. Also, this China shift is a very important shift because now it was important because of what happened during the disturbance and COVID and other problems, but now it has become even more important because when companies migrate in order to mitigate risk from one country to the other, it takes them time. It is not like all of a sudden the company that is doing business, like suppose Apple, if it's doing business in China, cannot say all of a sudden tomorrow morning I'm going to pack my bags. They will take time to come to India, to find a base, to find a vendor, to sort of clear government policies. Already we are trying to get Tesla, and it's already taking so many months, etc. So when that transition happens, there's a reason. Now with more geopolitical problems which have emanated with Russia, and now with China, and there's a threat about what China will do vis-a-vis Taiwan, etc., etc. There is a greater probability that some of the companies which are more stable for business will get sort of a thumbs up from some of their from somebody who wants to do large scale manufacturing. So the PLI scheme will take off. It will take time, and there may be a lot of benefit. While there may be a Dixon today that looks to you to be an obvious beneficiary, I think there will be you'll be I'll be very surprised that if some of the other companies, particularly some of the manufacturing companies in India, do not become their own Dixons.
Hello.
Yes, sir.
Yes, Shyam sir, please ask your question, sir.
Safi sir, very good evening, and very good evening to all the host and the all the listeners. Safi sir, my question is, since I am the investor who started investing nowadays. I mean, it's a beginning stage for me. So my question would be for you, sir. I know ki, when we listening you, it's very fascinating to you know to keep listen you for a long time, because I have attended a lot of your such as sessions, and it becomes very for me it becomes very it sounds very good for me when you speaking. So my question would be, sir, I know there would be a take a lot of time to learn the markets, or you must have done a lot of study behind that. So what would be your advice to the beginner? I mean, where he can start, and what things he needs to keep in mind, which books, or maybe you can refer for a beginner, just to identify a particular company which he wanted to invest. So this sort of advice would be very highly appreciated from you, sir.
See, sir, first of all, a person who's new in the market is at an advantage compared to a person who's been in the market, simply because when you're in the market for a longer period of time, you too tend to have biases, and you sometimes also tend to become overconfident, because sometimes your past returns may, like, let's assume that I made good money. Suppose I made good money in 2020 and 21. It may be cause of my mistakes in 22 or 23, because I may just sort of brush a lot of dangers. And if you know the story of the crocodile Dundee and the gentleman who died, you will know that while he was experimenting with crocodiles every single day, it was just the sting of a starfish that killed him. So sometimes they get too complacent. The what a new investor should do more than anything else is that he should become a reader. And the reading can be very different. Reading does not have to be necessarily only of companies and their analyst calls or annual reports. Sometimes it could be something like a book, a good book. Sometimes it can also be newspapers, because what happens is that when you start reading initially, it doesn't it may, you might find it boring or you may not enjoy it, but over a period of time a lot of things settle in your mind. And the mind then is able to use a lot of variables, because the brain is working even when you sleep. The brain is able to churn a lot of information that it believes is important, and it's able to eliminate what it doesn't think is important. So for example, if you tell me today that the market in India is corrected and it is a brilliant opportunity to buy, my brain will say no, and it may have been ordinarily so because some of the good companies have corrected, but we don't know where this world is heading vis-a-vis Russia, and how long. Maybe, for example, suppose the commodities remain high for 2 years, then the market may not move up for 2 years. So the pain of owning that capital itself may be a lot. But on the other hand, if there are, and look at this, like for example, everybody was talking about private sector banks, but it is actually the public sector banks that have outperformed. People were saying no, PSUs are not good stocks to own, but it is the PSUs that are outperforming in this current year. So this thing will keep coming and going, and you should just read a lot about what is happening around the world, because it will guide you. At the same
Uh,
time, it is very important for you to have your own mind, because if you like, for example, I sometimes when I come on Twitter and I write about some, say, company or some sector, I'll always find some people will come and disagree and they will give their own things and all that. Now if I get too swayed by thinking that everything that so I can read what they say, but I'll have to frame it in my mind that have I factored it in the stock that I'm talking about. I'll just give you an example, and this is, I don't own that stock, but I'll give an example. When recently the issue came up that Heikel was subject to a closure notice by the municipal authorities, I said common sense will tell you that they will go to a court. Now, whether they will succeed in court or not succeed is the second thing. Assuming they were not to succeed in court, the bad news was already in the stock price that day, because it had opened at some 370 odd rupees from a previous closing of 400 odd or something like that. And if they were to get a stay, then the market will give them some relief. And what had happened that day is that the stock actually opened at 370, came back to 392, 93. I actually had that stock that day, and I actually tweeted that because at the end of the day means market trading day, the stock did nothing. despite flashes all over television, all the debates on Twitter, and so many people talking, then I said that, you know what, the uncertainty is actually not even being priced, so I might as well exit because I don't have to wait for this thing. So you have to use a little bit of common sense, which is what Peter Lynch's discussion is. His common sense is not just going to the market and finding something; it is also using your common sense. And you come and say, why do I have to, in a universe of some 8,500 companies, why do I have to find this one company to invest in which is already in the midst of uncertainty? Similarly, take an example of KRBL. Now they've gone through one problem, second problem, third problem. It just doesn't get over. Now the last is that the distributor has moved on and he's no longer the distributor because he's involved in some other cases. And you come and say, you know what, is this the management? Was it so prudent that knowing all these problems for the last several years, they were not able to resolve it? So it may be cheap. The stock may be cheap. The stock may go up. I have no idea. But the point is that when you look at it and you come and say, what am I betting on? I'm betting on the wisdom of the management. And wherever they are not showing it, there are 7,999 other companies to invest.
Sir, just one. Hello, Safir ji, Anant here. Can I ask my
Hi,
question?
good evening. Yes, sure, sir.
Yeah, hi. Anant here from Bangalore, and I was just listening to this really nice podcast. So I really enjoyed it, and thank you for all your information, and thanks host for allowing me to speak. And special thanks to Safirji because you proactively allowed listeners to ask the question that I really liked. So coming to my question, so what is your view or opinion on the infrastructure, the Indian infrastructure, and particularly in terms of railway infrastructure? So that's my question. Thank you.
See, sir, the if you look at the potential that the Indian Railway owns, it is going to be huge. Simply because we have seen how the rail have become a very dominant part of places like Europe. We know the level of penetration that the railway has. We know that the railway is a measure of not only passenger traffic but also very efficient transportation of goods. And now companies such as Container Corporation are doing double rakes, and therefore they, in existing infrastructure, without increasing the cost much, they're able to do double load. The problem is that you really don't know how the government behaves, which means that, for example, right now we are on the midst of assembly elections in Uttar Pradesh. You know, the oil prices have soared during all this time, and you can hear it every single day in the newspaper that the oil marketing companies, that is BPCL, HPCL, are saying that no, you're not been hiking prices. Now we are going into losses. Similarly, we are going into losses with gas. Now, you know what has happened to the gas distribution company. So, wherever there is going to be a balance between public interest and private interest, which is going to be a consideration for political reasons, it is not very clear whether you will make money.
Okay, yeah. Thank you, Safirji. Thank you. Hello.
Great. Thank you so much for that. Yes, sir.
Sir, just to add, I
Uh,
mean, to my last question, as a beginner investor for a Safi sir, any sir, recommendation with start with reading for some of book.
Yes, so that depends on your interest. Like, for example, some people read charts, some people read books. I like to read books. Now, when you're looking at, if you want to believe in long term growth, the books are very different. They start with Warren Buffett, they start with cash flow, they start with Professor Jeremy Siegel. If you want to read books which are more complex, then you start reading more complex books, which could be on artificial intelligence and how it is going to disrupt the world. Now, look at it. If you look at the IT industry, it has demonstrated every 5 years or every 6 years that a new thing originates that creates another catalyst. And despite more and more people coming, you knew TCS was there, Wipro was there, Infosys was there, HCL was there, and more companies continuously, Mastic, Mindtree, whatever, Emphasis, they keep coming, but the industry size keeps growing because the industry keeps migrating from one thing. It started with Y2K, then it went to something else, and now it's gone to cloud, now it will go into artificial intelligence, then it will go into robotics and many other things. Then you come and say that the longevity here is a bet on the promoter's ability to transform the business model. And any guy who's able to transform his business model swiftly has always been able to be ahead of the curve, and they've always survived and done well. Just as Apple started with one product and went into another, Google started with one product, went to another, Microsoft was selling computers and moved into software, IBM is now changing its business model, and you come and say that, you know what, the longevity here is enough. So reading is essentially a function of what you want to be aware of. If you want to read on IT industry, it's very different. You want to read on politics and you want to play the market based upon political considerations and announcements or policies, it's very different. You want to read, become a very avid reader about metal cycles, is very different. You want to just believe in stocks over the long run, then you just basically read books that are on investing and compounding over a period of time.
Thanks. Thanks.
Okay, we have 5 minutes more, and then at 10:30 we can close.
Yeah. Sai Kiran sir is there with us. Sir, are you there?
Hello.
So he is. Okay. Yeah, please ask your question, sir.
Yeah. Hi, sir. Sir, with respect to HDFC Bank and all the HDFC Group, especially, I am referring your tweets on a regular basis, and you have some. I mean, as per your institution, you are of the view that ICICI and SBI might do better than HDFC. I just seeking some of the quantitative or the facts which which made you weigh ICICI and SBI over HDFC, so that I can correct my view and I can also revisit my views.
So if you look at ICICI and SBI, they're both different answers. See, ICICI has suffered from a leadership problem that we all know, and I will not talk much about it because it was already there. You know about the criminal cases, etc., that happened, and after that, they have had a leadership change. That new leadership has been extremely quiet. You hardly see any interviews from the new leadership, and they have gone around transforming. If you look at the gap that existed between HDFC and ICICI in terms of the growth rates or in terms of deposit rates or in terms of quality of assets, etc., it was always in favor of HDFC Bank, and therefore HDFC Bank has commanded a significant premium historically compared to ICICI. That ICICI has now started capturing all that, and they are narrowing the gap. So that is on the statistical part. The second part is that I am a client of HDFC Bank and I'm a client of ICICI. And I'll just narrate to you, last week itself, I had got in touch with both to explore a certain loan for a property that I wish to buy. ICICI Bank completed my process and within one day. And they went through all the documents, some 8-page documents, this title, that title, your net worth certificate, CIBIL report, this, that. HDFC Bank is even today asking me what is to be done. So, that is the second, that is Peter Lynch, that basically go where the services are much more rewarding. The third is that look at the level of over ownership of HDFC Bank historically versus ICICI Bank. Now, in HDFC Bank, there are problems which come from the fact that they never left efficiency. Everything of efficiency had been squeezed. They had a dynamic leader, Mr. Aditya Puri. He was doing very, very well, and he was capturing till their business model got hit because the credit card business got impacted initially. Then they had to change from being a lending bank into a corporate sort of bank. Then they had to also look at the problems that were emanating from over ownership of FIs. There's no FI limit left, and therefore everybody wanted to squeeze the last drop. Then ICICI, then you started looking at their companies and saying that, you know what, everything is at the shamble level. And the real test is happening of good management is that the transformation doesn't happen in one company, it happens at a group level. So the way they have transformed ICICI Securities, the way they are trying to bring up the Lombard and the Prudential business. Now, of course, I may not be invested in the insurance business, but that may be a different reason. So I look at the entire picture and say it's a great opportunity. In State Bank of India, the answers are completely different. State Bank of India is a very, very large bank at a ridiculously low valuation with a whole lot of historical problems. You didn't like the service, they changed it. You didn't like the people, they're changing it. You didn't like the technology, they've got the best. That YOLO is the best app that I know in the banking, one of the best apps in the banking. You should look at the number of people. They have changed their management vis-a-vis SBI card. They've changed their management with SBI insurance. They've got so many things working. Now they don't have NPAs because even having gone through all the bad experiences, they've cleaned up the book. There's nothing left in the book that is not to be cleaned. I mean, barring some small thing like Russia, yeah, even in Russia, which bank has come and given you a statement in the newspaper that our exposure to Russia and Ukraine is X? State Bank of India has given this within a matter of 2 hours. So there's a lot of transformation happening. And then look at the credit growth. If you're looking at the penetration of financial services in India, and today rural India is looking more stressed, but when it sort of picks up, it has the bandwidth to reach every single place. So it gives an entire bouquet of services overnight, and yet you may have unprecedented gains. Today they cannot give you an equity in the YOLO thing because the YOLO only supplies to a SBI. They cannot take on other people because there are regulations and laws, etc. But tomorrow, if they decide to convert that into a third party software, it that third party software itself will be bigger than the market cap of SBI.
Right.
Yeah, thanks, thanks,
Great.
thanks a lot, sir. So, sir, as per the what you said, so I can read HDF, ICICI and SBI are equally competitive with HDFC. Right? I need not put one ahead of the other, right? I mean,
No, but why? See, when you like certain stocks, you don't have to take a call on, like, for example, if you ask me in my portfolio, what's my most favorite stock? My answer is my most favorite stock is the one that gives me the best return. How do I know which stock is going to give me the best return? I only have an idea. I'll say, you know what, if you look at my portfolio, I'll say, okay, these are five or six companies that they may do better. But in reality, you will discover that the guy who does the best will be the seventh or eighth guy that you did not pay so much of attention. And why is he going to do better? Because when you're not paying attention, others are also not paying attention. The market is therefore not factoring in the growth that comes in. That is why sometimes your best returns will come in from these small caps that you've ignored. They'll all become 5 times, 10 times, 20 times. When I started this call and I was giving an example of the aquaculture company, it became a 100 bagger, no?
yes, yes, sir.
पता थोड़ी होता है, अगर आपको अगर शुरू में पता होता कि 100 bagger है तो आप सारा 100% मनी उसी में लगा देते, पर ऐसा होता नहीं है. एंड इफ यू इन्वेस्ट so much more into it and it fails, then you will not be able to sort of come back. So that is why do you see even the smartest of fund managers, when they manage money, they don't have more than usually 10% into a stock.
Yes, sir. Got your point.
Right.
I think now we
Uh,
can wind up. Yeah.
yeah, that was absolutely smashing, absolutely brilliant, sir. Thank you so much for that. Thank you, listeners, for listening to us. Thank you, the people who asked those great questions, and sir, you handled them beautifully.
Yeah.
Once again, I
With, with your permission, can I take the last question with Safir if you give me that opportunity?
sir, unfortunately, we are hitting a hard stop time, but I'll leave it up to Safir, sir.
Okay.
So nice of you. So nice of you. Safir, exactly not a question. You know, I really appreciate because you are such a optimistic investor. There's so much of optimism in your study because I feel that you are like, you have some first principle thinking. You practice it very, you are a voracious reader, and we all can make out from the great knowledge you have. But the optimism in your entire thesis is something, which always one look forwards to your space. And the kind of a value investor, I would say, that you are, because you keep quoting Peter Lynch very regularly. So, Safir, I would just like to ask you, sir, that in the present status where we're hearing that it is a rising India, and most of us, the optimist, learned investor, do believe that yes, this is one decade. Maybe we are in a generation, probably I would say in a century, that has got once in a lifetime opportunity to make not money actually, but wealth, if we actually apply the knowledge gained, and all of you so learned people are around. What is the space which, Safir sir, you'd say that today a value investor in the Indian equity market should be attracted towards more, in the sense that mid cap, small cap, or large cap?
No, I can't give a precise answer to mid cap, small cap, or large cap, because there will be large caps that will continuously become bigger, and they may continue. For example, it may also happen like it happens in America, that a very large company may be split into parts. And when it is split into part, it itself becomes three or four small caps, or small three or four mid caps, because managements may decide whether businesses become too large to focus as one unit. Similarly, there may be a mid cap that may be doing very well right now, but may hit a certain sort of a wall, because after a certain point of time disputes happen between the promoters. It is happening right now. It happened in Indigo. For example, just a few days back, Indigo stock was at say 23, 2400. Now it is hit high oil. Similarly, Mr. Gangwal's going is now construed to be, because they say that he was one of the think tanks. Now, what is the ramifications of that? If you're holding, are you going to think that the Mr. Bhatia will continue and he will transform, or will he sort of mess it up? It's very difficult to take a call. That is why it is always good to be script specific. It is good to be time wise spread, and it is good to build up on your convictions when they're proving right. And if you're moving wrong into the market, like right now itself, for example, while some minutes back there was a flash that oil had cooled down, to think that what is going to be the consequence of the market tomorrow. And I'll say, you can ask me why is it important tomorrow. Because generally if the market changes sentiment, because oil changes or Russia cools off or some India lag happens vis-a-vis the world, it there has to be the first step that leads to the next. That step has to come somewhere. So for example, if the market, let's assume that for some reason the market has a say 1000 point or 800 point on BSE rally tomorrow, a lot of people will find reasons to start spotting, to finding stocks, and then overall losses that went to 15%, 20%, whatever percent it went to, when they start narrowing, they'll start believing. But if this have a sudden sort of pain every day, it doesn't sound so much when the market falls only 0.5, 0.6, but when it falls from 1st January to the whole of February, and you say you're down 15, 20, 25%, then a lot of your convictions to invest at that point of time fresh money go for a toss, because your first positions are already getting hit every single day. So it's really a very difficult call to decide on what you do. I for example, will look at scripts, and if I find that there's value, so I'll tell myself, like for example, today also I bought in the market. Now I'll tell myself, you know what, this money is important for me. It's lying in the bank. It is likely to give me 5 to 6% return. Can I beat that 5 to 6% return for the year? I've just put this question to myself, and I said, you know what? Out of this 6% odd return that is the bank will give, 1 or 2% the company will give me just by way of dividend yield. So I actually have to beat the market, or that by buying the stock, I only have to do some five odd percent return for the year. I feel that in the worst of problems, that 5% to 10% sort of returns I can still do in those scripts. Maybe if I'm lucky, it will happen in a matter of few days and less than a month. If I'm not, it will happen in the year, and still, therefore, the risk to reward is in my favor. Then I'll say, okay, what happens if there's a drawdown? What if the script goes down 10%? I'll say, oh, you know what? Then the chances of making that money will slightly improve, because that will be like a sort of a knee jerk reaction that may sort of not materialize over a long term. And I'll say, I'll move on. So then I will put some money. So will I put all the money on the same day? No. I could have nibbled a little bit today, and if the market is not good the next 2 3 days, I'll nibble a little bit more. If the stocks goes up, then I have no regret, because I bought a little bit and I've sort of rewarded myself.
Right. Thank you so much once again for that, sir. Thank you so much for going out of bounds and taking that question. Once again, on that great note, let's close this beautiful session. A recording of this session we'll tweet it within the next 5 minutes. You can of course listen to it again. I am sure I want to listen to it again to absorb it even more. That was absolutely beautiful. That was absolutely smashing, Safir sir. Thank you so much for joining us, and I can't wait to have you again.
Thank you,
Safir sir,
everybody.
thank you
And
so
just as
much
a
for taking the
standard
last question.
disclosure,
Thank you so much.
thank you so much. I just as a standard disclosure, I'm not a SEBI registered advisor, and the views expressed and the examples that I've borrowed, some of those examples were for your learning. I may not even own those stocks now.
Right. Great. So thank you so much, everybody. Have a really good night ahead. Have a really prosperous day tomorrow. Bye bye. Good night.
Good night. Bye bye.